Okay, well, we are ready to review. So today we are going to review chapters 10 and 11 for our exam on Tuesday, okay? And I just realized, so we will be testing in class over 10 and 11. So what I did to make it easier, I normally do examples on the board, you know, when we go through. Well, I just decided it'd be easier instead of me trying to come up with numbers and then, you know, having all that fun. If you go out under Unit 2, kind of down towards the bottom, there's actually something titled Exam Review. If you click on that, it should open up in Cengage, and we're going to do some of the hands-on review together. So I basically went through the test and identified what you'll be responsible for hands-on. Okay, so there's still multiple choice that we'll talk about, but really, as you can see, I have like 9, and I think that's pretty accurate as far as the test goes. So there'll be stuff from 10 and 11 that these will be very similar to what you'll see on the exam. Okay, some of the time it may be the exact same problem, just different numbers even. So
are we still going to be able to get 2 pages for the notes?
Yes, you sure can. Yep. So yeah, you can still, as far as the exam structure, it'll be the same. It'll be multiple choice and hands-on. And you can still bring 2 pages of notes, scrap paper, calculator, pen, pencil, all of that fun stuff.
Can you print it off?
Oh, if you want to print off your notes, that's fine.
Okay.
Yeah. I'm all about typing instead of handwriting. So if they're electronic, that's completely fine. Just print them off and bring them. So chapter 10, if you remember, we dealt with current liabilities, okay? So I'll go over kind of the multiple choice things to go over first, and then we'll do these examples. So, I mean, as far as your multiple choice, just review terminology from chapter 10. So for example, a current liability. What is it if we say a liability is a current liability? What does that mean?
Paid off in the next year.
Right, exactly. It's a current, it will be paid off in this year, okay, within our fiscal year, okay. And as far as what current liabilities we dealt with notes payable, you know, like short-term notes payable, and then we dealt with payroll, okay, both the payroll itself, the payroll expense, and payroll tax expense, okay. We also covered installment notes, but I did not put that on the exam for time's sake. You know, those took a little bit more time to calculate. This first one kind of talks about one of the multiple choice ones too. As you can see, the first example we're doing says proceeds from notes payable. Well, what does it mean when I say proceeds? What is proceeds? Yeah, very good. What we get, okay? So the note proceeds are the amount of money we get when the note is issued. When we issue the note proceeds are the amount we get. So if it's an interest-bearing note, the proceeds are just the face value, okay? If it's a discounted note, the proceeds are going to be the note minus the discount amount. Okay, so the proceeds are the cash that we're receiving, basically, okay, when we issue the note. And we're actually going to do one of those first here in just a minute. Okay. And then know how to report the current portion of long-term debt. So say we have a long-term notes payable, like a mortgage note. So we pay it monthly, you know, but we pay it for 30 years. So what portion would I report in the current year as current liability? Yeah, just what we pay this year, right? So it's, I mean, it sounds kind of like a trick question, but if we have a mortgage note and it's like a 30-year note, whatever's due this year that we're paying this year, we recognize as a current liability. And all the other remaining years are a long-term liability. Makes sense, right? Okay. And then for multiple choice as far as payroll, well, remember when we were journalizing payroll, and we're going to do one together, when we were journalizing payroll, all of the payroll taxes and any withholdings, really any withholdings from the employee's payroll were credited to liability accounts, like payables. You know, you had Social Security tax payable, Medicare payable, federal income tax payable, health insurance payable. I'll stop there. But just kind of understand that. So all payroll withholdings are credited as a liability account because we're just journalizing how much we're withholding and then we'll pay them later, okay? I would know the difference between what's deducted from the employee's pay versus the employer's payroll tax expense. Okay, so that's a big one because you'll be doing journalizing on it and you'll want to know. So as far as the employee, what taxes and withholdings does the employee have that we withhold from their paycheck?
Medicare, Social Security,
Mm-hmm.
FICA, or
FICA is Medicare and Social Security.
Okay.
Yeah, good.
and also state.
State and federal, good. Anything else? Unemployment's a payroll tax. Yeah.
Is it for retirement?
Retirement, good. Well, the required withholdings are, like you mentioned, the Social Security, Medicare, and income tax. Federal's required, state depends on the state, right? Like in Oklahoma, we withhold state. And then we have all of those optional deductions like retirement, health insurance, garnishments, charitable donations, anything else that the employee has, or the state has authorized if it's a garnishment. Okay, so those are all what the employee is responsible. It's coming out of their paycheck. So Medicare, Social Security, income tax, and then like any other charitable contributions, retirement, health insurance, anything like that. Voluntary contributions, okay? Now, what about the employer, the payroll tax expense? What is the employer required to pay?
The SUCA and the
SUDA, yeah.
SUDA,
Yeah.
yeah, and the KUCA.
FUTA, yeah.
SUDA, okay.
Close enough, right? What are those?
I forgot.
Unemployment.
Oh, yeah.
Yeah, very good. But yeah, the FUTA and the SUTA, so the federal unemployment tax and the state unemployment. And then what other things are the employer's payroll taxes?
Don't they do the Medicare as well?
Yes, very good. They have to do Medicare and Social Security. Okay, so the employer, the payroll tax expense for the employer is Medicare and Social Security, which are your two FICA taxes, and then you have FUTA and SUTA, so both federal and state unemployment. Okay, good.
On the one about the employer, so when the employee has the Medicare deducted from their check,
Mhm.
isn't it ultimately taken out of also the employer's check? Or are those like two separate accounts where it's like two?
We make two journal entries when we do payroll. So we journalize the employee payroll, and we're going to do that. So we're going to show like their gross pay and all the withholdings, and then their net pay. And then, so that'll show the Medicare and Social Security the employee is taking out, that we're taking out of their paycheck. And then we do a journal entry for our payroll tax expense. And there you're going to see our Medicare that we have to pay for every employee, Social Security for every employee, and then the unemployments.
Okay.
So they're two separate journal entries. But ultimately, we as the employer are paying in Social Security and Medicare that matches what the employee is contributing.
Cool.
And then when we're talking about payroll, just know the difference between gross pay and net pay. Which one's take-home pay?
Net pay.
Net pay. Very good. Okay, so our net pay is our take-home pay. Gross is before any withholdings. Okay. So that's the stuff I would really know, like understand, have a basic understanding of for multiple choice. And then let's work through some of the examples. Okay, so we are on, if you're on Canvas, this is called exam review. It's a non-graded, but hopefully helpful. Okay, so these will be similar to what you'll see on the exam. Okay. So we have on January 26th, Nairi Company borrowed cash from Conrad Bank by issuing a 45-day note with a face amount of $150,000. So this one, we just want to determine the proceeds. Well, you guys already told me what the proceeds meant. That's the cash we're receiving, right? So if it's on A, it says determine the proceeds of the note, assuming the note carries an interest rate of 10%. So this is just a typical short-term notes payable bearing interest. What are the proceeds of the note? How much cash am I receiving? 150,000. Yeah, don't overthink this one. It's just when we issue the note, how much money are we receiving? So when it's an interest-bearing note, we receive the full $150,000. Okay, so we basically are debiting cash and crediting notes payable 150,000. Okay. What if that same note was discounted at 10%? Are we going to receive the 150,000? No. How much are we going to receive? Bless you.
148,125.
Very good. And how did you get that?
You multiply the 150 times 45 times 10% divided by 316, subtract that from the 150.
Very good. Okay, so you calculated the discount amount. So he calculated the discount amount basically by taking 100, just calculating your normal interest, right? Principal times rate, what was it, 10% times time. Okay, so we got a discount amount, which was what, 1,875? Okay, so we calculated the discount amount just like you would calculate interest. It's the same calculation. Principal times interest times time and days over 360. And then he took the 150,000 minus 1,875. So the proceeds or the cash received is 148,125. Okay. So really, when you have a discounted note, just calculate the discount amount and then subtract it by the from the 150. Okay. Any questions on that one? That one's not too bad, right? So just, I wanted to cover it though, because sometimes that word proceeds throws students off. Oops, I didn't put mine in. Okay. Okay, well now we're switching gears just a little bit and we're looking at payroll, okay? So this one is journalizing the payroll for the period. So the payroll register of Heritage Company indicates, and they give us Social Security, Medicare, and the total salaries is $65,000. They give us federal withholding and retirement. And it wants to journalize the period's payroll. When it tells you to journalize the period's payroll, are we journalizing the employee's pay or the payroll taxes? The employee's pay, okay? So when it says to journalize the payroll, you are journalizing the employee's pay, okay? So what do I debit? Very good. Salaries expense gets debited for how much? $65,000. Very good. So remember, when we're journalizing payroll, we always debit salaries expense for the gross pay. Okay, the $65,000. And then what do I credit?
Social Security tax payable.
Very good. We're going to start with like Social Security tax payable, Make sure you choose the payable and not the expense. Remember, these are all liabilities. So Social Security tax payable, they give us the amounts. We don't have to calculate it. So it's $3,900. And then what's the next one? Medicare, good. Medicare tax payable, a credit of $975. What's the next one?
Employee tax income payable.
Very good. Employees, federal income tax payable. And again, they gave us that at $14,250. $14,250. And what's the next one? Retirement, very good. They had a retirement savings deductions payable. A lot of words there, right? $2,600. So retirement savings deductions payable, $2,600. So again, those are all credits to payable accounts to liabilities. And then what's the last thing I credit? Good, very good. You guys got this. Salaries payable gets credited for how much?
$40,275.
$43,275. And how did you get that amount?
You took all the payables and subtracted from the $65,000.
Very good. We took our gross pay, the $65,000, minus all the withholdings to get a net pay. The salaries payable is how much you're cutting the checks for. Okay, so that salaries payable is your net pay, or the take-home pay for the employees. $43,275. Very good. It's not too bad, right? I think these chapters are probably easier than the first two. So you guys are all going to make A's on this test, right? And then we'll have a pizza party. Right? And not Little Caesars. We'll have something better. And not CC's. I can't eat CC's pizza. I'll actually eat Little Caesars, though. I'm like not that picky. If I'm paying for it, we're going to have something better. If it's free, I'll eat whatever. The what? I love the wedge. It is so good.
I'm so happy they're right there.
I know. They built that new one, the wedge in the drum room. I haven't been over there, but
It's like the same.
like I know all the food places, right? Yeah, and then also at the wedge, they have those like prosciutto wrapped pears with the balsamic. Yeah, now I'm hungry. Okay. It wouldn't be the wedge. I'm not rich, but maybe we'd get like Domino's or something, you know? Now we all want pizza, right? Or food of some sort. Okay, so this next one is dealing with the payroll tax expense. Okay, payroll tax expense. So again, they give us Social Security, Medicare, total salaries. They tell us earnings of $10,000 are subject to state and federal unemployment, and they give us the rates. So when I'm doing the payroll tax expense, what do I debit?
Payroll tax expense.
Very good. We debit payroll tax expense. So again, we don't know that number yet, do we, though?
No.
Okay. So what am I going to credit?
You can credit Social Security expenses.
Payable, remember. Yeah, Social Security tax payable gets credited. Make sure you use the payable account.
What is that an expense then?
It won't be an expense. It'll be a payable.
Okay.
Yeah, they try to trick you with that. So always record them as payables. Okay. We're just not paying them right now. We're just creating the journal entries and we'll send the money later. The expense is all recognized here in that payroll tax expense. We kind of put it all in there. So, and they gave us that $3,900. Notice this matches, the last one. What else do I credit?
Medicare tax payable.
Perfect. Medicare tax payable, and that's the $975. State unemployment, good. How much is the state unemployment tax payable?
State's 5.4%.
5.4%, good. Of how much?
$10,000.
10,000. So be careful on this one. Remember, we only pay unemployment on a certain amount of the wages, and they told us earnings of 10,000 are subject to state and federal unemployment. So you're only calculating unemployment off 10,000, not the full 65,000 wages. Okay? So be careful of that. So state unemployment tax payable would be 5.4% of 10,000.
Which is
$540. Very good. It's always nice when they're even numbers, right? And then last but not least, we have our federal unemployment tax payable, which is 0.8%. Okay, that's a small percentage. So if you're entering it in, you know, in your calculator, you'd put 0.008. Okay, that throws students off sometimes to have a 0.008. What's my federal unemployment tax payable?
$80.
$80. Perfect. So we put 0.8% of 10,000. Okay. So again, from the employer side, the payroll tax expense for the employer, these are what the employer is paying. Okay, these aren't being withheld from the employee. We're required to pay Social Security and Medicare, matching the employee, and then both state and federal unemployment. So what's the total payroll tax expense? $5,495. Very good. I had it in stereo. Okay. So when you see payroll tax, that's what the employer is responsible for paying. So you add up Social Security, Medicare, state, and federal unemployment. You need to calculate those four, add it all up to get the total payroll tax expense. Any questions on that one? All right. Rocking and rolling. I think this is our last example for chapter 10. So this is just an entry for a notes payable. So we're looking at journalizing. You want to know how to journalize the issuance of a notes payable and the payment, okay? So as you can imagine, when you're studying, just refer back to this exam review, because this is what you'll be responsible for on the hands-on portion, okay? Did you have a question?
Yes. So I get these confused all the time, so I just want to make sure I get it right.
Sure.
It says like a business issued a note to something,
Uh-huh.
somebody else. Which one is the creditor and which one is?
Okay, good question. So when it says a business issued a note, the person or the business issuing the note is the one that owes the note.
So they're the borrower.
Yes, yeah. It's a good question, because when we think issued a note, sometimes it kind of gets confusing. So in this chapter, we're always going to owe the money. It's always going to be a liability. We're always going to be the one issuing or borrowing. That's a great question. Sometimes the terminology just trips us up. So yeah. Okay, so in this case, yeah, we have a business issued a 120-day 5% note for $90,000 to a creditor on account. So we're the business that's issuing a note. So we're the ones that are borrowing or, taking out this note. It says journalize the entry to record the issuance of the note in A, and then B, the payment of the note at maturity. Okay. So on part A, what do I debit and credit when the note gets issued? Very good. Accounts payable, because in this case, they told us it was to a creditor on account. Okay. So it's accounts payable. If it said for cash, you would want to debit cash. Okay. And how much am I debiting? The 90,000. Good. And what am I crediting? Notes payable. Very good. Okay, so when we issue a note, in this case it was on account, so debit accounts payable and credit notes payable for the face amount, the principal 90,000. Okay, very good. For part B, I need to calculate my interest, don't I? I need to know how much interest I'm paying. So how would I calculate, what's my calculation for my interest?
90,000 times 5% times 120 divided by 360.
Very good. 90,000 principal times 5% interest rate times the time and days, which would be 120 over 360. Okay, so 90,000 times 5% times 120 over 360. Okay. If you remember, that's always our interest calculation. Principal times rate times time. So what is my interest? Very good, 1,500 in interest. So I calculate my interest. So on part B, when I'm paying this note at maturity, what am I debiting and crediting? What am I debiting?
Notes payable, interest expense, cash.
Very good. I debit notes payable for how much?
90,000.
90,000. Very good. And then we debit interest expense for how much? Yeah, the total interest is 1,500. Okay. And then we credit cash for how much? The total amount, right? You want to do your principal plus interest, that maturity value. If you remember, maturity value of a note is the principal plus interest. So 91,500. 91,500. So try to keep these pretty clear. Nothing too confusing. And there's no like partial interest, you know, like when you have like a note that extends over 2 periods, 2 years. So it should be pretty straightforward. Any questions on that one? Do what now?
On the quiz, it asks us to do the other side.
Oh, from the one that's, uh-huh.
How is that? Is that in-
Well, remember then it's going to be a note receivable on their end.
So they're debiting notes receivable.
Uh-huh. Uh-huh.
And then before we say debit cash.
Mhm.
And then credit receivable.
Uh-huh. Interest revenue for them. Yeah. So yeah, if they're the creditor, they're the ones receiving the money, it's going to be a debit to cash, a credit to notes receivable to close it out, and then a credit to interest revenue. You won't have that on the test, but yeah, it is on like the exam prep quiz. Any questions on chapter 10? Okay, awesome. Let's get into chapter 11, the really fun stuff, right? Okay. So chapter 11, of course, was on bonds. Okay, on bonds. So as far as what you want to know on bonds is know, the difference between market rate and contract rate. Okay, so we know, for example, we'll start with the easy one. When the market rate of a bond equals the contract rate, we know we sell the bond at the face value, okay? So it's sold at face value. That one's easy, okay? So when the market rate, again, the market rate is the current market as far as like the stock market, the current stock market rate of interest. The contract rate of a bond is what we've stated that we're paying out in interest. Okay, so the contract rate is the amount of interest that's getting paid on the bond. The market rate is the current amount that's available on the stock market. Okay, so when market rate equals contract rate, we're selling the bond at face value, or what we call par value, and that one's pretty easy. What happens if the market rate is higher than the contract rate? So we're giving them less interest than they could get on the market.
Discount bond.
Very good. We're going to discount. The bond gets discounted. So just make sure you have that in your notes. If the market rate is greater than the contract rate, we're going to sell the bond at a discount. And then, of course, If the market rate were less than the contract rate, you got it. We'll sell it at a premium. Okay. So I would definitely know that. Okay. So understand those. Selling at par or face value, selling at a discount, selling at a premium. And then understand the straight line method of amortization. A lot of words, right? And we're going to do some examples here in a minute. So straight line rate of amortization. Okay. Well, it's really the same. Remember, we calculated straight line rate of depreciation, and the depreciation expense was the same every year over the life of the asset. So the straight line amortization of a bond means that our interest expense is the same every year over the life of the bond. It's a lot of words, right? So straight line rate of amortization, all that means the interest expense is the same every year over the life of the bond. Okay. So amortizing a bond is just spreading out the discount or the premium over the life of the bond. And again, when we do that with straight line, it's the same amount every year. Okay. Any questions on that? Okay, you guys want to do some fun bond stuff? Whoop, whoop. Just what you wanted to do when you woke up this morning and you said, you know what I really want to do today? I want to journalize bonds, right?
Totally.
Totally. That's what I woke up and said this morning too. You know what I really want to do today? Okay, well, you know, we have to do it, right? It's not too bad though. Okay, so the first one is just issuing bonds at the face amount. So again, the contract rate is equal to the market rate. So we can issue the bond at the face value. So on January 1st, the first day of the fiscal year, Designer Fabric issued a $5 million, 6%, 10-year bond that pays semi-annual interest of $150,000. Hey, looky there, they gave you the interest calculation. You don't even have to do it. Isn't that nice? And they even told you how they got it. 5 million times 6% times half a year, right? Or 5 million times 3%. So we received cash of 5 million. So again, really try to take the guesswork out of this as much as we can. So when we issue the bond, what do we debit and credit? Very good. Cash and bonds payable. So cash gets debited and bonds payable gets credited. For how much? How much cash did we receive? $5 million. Okay. So bond issued at face amount, we just debit cash and credit bonds payable for the $5 million. Part B, journalize the entry to record the first interest payment. Well, they already calculated it for us. Semi-annual interest is $150,000. So what do I debit and credit?
Interest expense bonds payable?
It will be a debit to interest expense. Cash is credited. Yeah. Because you're actually making that payment to them. So we're paying them $150,000 of interest. And again, we're paying them this every 6 months over the life of this bond. Okay. So interest expense is debited and cash is credited for the interest of $150,000. And then the last one, it says journalize the entry to record the payment of the principal on the maturity date. So we're paying back this bond when it matures. What do I debit and credit? Bonds payable gets debited and cash gets credited. For how much? The 5 million, the face amount. Very good. Okay, so when we pay a bond back at the maturity date, we always pay back the face value. This is the same journal entry. You'll only do it at the face, when it's issued at face value on the test. But if we issued a bond at a discount or a premium or at face value, paying the bond when it matures is the same journal entry. We always debit bonds payable and credit cash for the face value. Okay. Any questions on that one? That one's easy, right? Don't make it too difficult. Okay. I thought I had the issuance of the, oh well, this is okay. I thought we were going to do our issuance first. Let me see.
So I do have a question. If they didn't calculate that for us, how would we, okay, so it says half a year, but it says a 10-year bond. If they didn't calculate that, how would we know? I would assume, I don't know, 10-year, and they have half a year.
Okay.
So the semi always means just half, right?
Yes, yeah. With bonds, when you're calculating interest, you're always doing how much interest has passed before we make an interest payment. So you're making an interest payment every 6 months or twice a year. Okay. So what they're saying is to calculate interest on a bond, you always take the same calculation: principal times rate times time.
Right.
So in this case, it's 5 million principal times that 6% is an annual interest rate. So we want a semi-annual interest rate. So we're basically taking it by 6/12, or 1/2 a year. I think it's easier just to always take that 6% divided by 2, in essence. So your semi-annual rate of interest is always annual divided by 2.
Okay, I thought too much into it.
You did, yeah. That 10 years doesn't play into it, the actual calculation of the interest payment. Yeah. All you're saying is that for 10 years, you're going to make 2 interest payments every year. Okay. Good question. It does get confusing. Let's see. Actually, skip down to number 7 because I put them out of order accidentally. I don't know how. So make sure you're on number 7, BE 11-02, because I want to do the issuance of a discounted bond before we do the amortization. It's in order. Okay. So this one, issuing bonds at a discount. So this one, on the first day of the fiscal year, a company issues a $2.5 million, 4%, 5-year bond that pays semi-annual interest of $50,000. They receive cash of $2,400,000. So when I issue a bond at a discount, what do I debit and credit?
Interest expense, discount.
Okay, cash gets debited for how much?
It's 2.4.
Very good. The amount of cash we actually received, $2.4 million. Good.
I think the credit would be, someone said discount, but isn't it a premium?
This one's a discount, yeah. So when we've received less cash than the face value, we've discounted. This bond has been discounted. Okay.
Yeah.
Okay. So when the cash proceeds are less than the face value, we know this bond has been discounted.
Okay, number 8 would be the premium. I'm not even thinking.
It's okay. So what else do I do?
We will credit discount on bonds payable and also bonds.
Okay, you're on the right track. We actually debit discounts on bonds payable.
Okay.
Yeah. So discount on bonds payable gets debited and bonds payable gets credited. Well, what would I credit bonds payable for?
For the face amount.
The face value, very good. Bonds payable always gets credited the face value. So the $2,500,000, okay? Bonds payable always gets credited the face amount. So how much did I discount this note, or this bond, sorry? 100,000, right? The face value was $2,500,000. We received cash of $2,400,000. So we discounted this bond $100,000. So I'm going to debit discount on bonds payable. So when you issue a bond at discount, Discount on bonds payable is a contra liability.
Oh, sorry.
It's okay. Bonds payable is our liability account. It increases on the credit side. Discount on bonds payable is a contra bonds payable or contra liability account. So it actually increases on the debit side. Okay. So when you issue a bond at a discount, go back to college accounting procedures. Total debits have to equal total credits, right? So if you can't remember if you debit or credit it, balance your journal entry. Okay. My 2 debits equal my credit. Sometimes you just have to approach it a different way, right? If you don't remember. But if you have it in your notes, issuing a bonds payable, and you have the structure, a discount, issuing a bond at a discount, then you'll remember. Okay. Any questions on that one? Okay, so that's issuing a bond at a discount. I'm going to go back to number 6 now, the BE 1103, back to number 6. And notice it's the same numbers. They won't be this way on the test probably, but in this case, it's the same numbers, which makes it a little bit easier. So again, we have the same bond, 2.5 million, 4% 5-year bond, and they gave us the interest calculation. We're paying $50,000 in interest, receiving cash of $2,400,000. We're calculating the amortization. So we're journalizing the payment of the interest and recognizing the portion of that discount, okay? So this one's a little bit trickier, right? These are when it gets a little harder when we're amortizing a bond. So we will calculate it here in a minute. What would I debit and credit though? Any idea? Interest expense gets debited, very good.
Discount on bonds payable would be credited
Very good, yeah. Discounts on bonds payable will be a credit
and cash.
and cash will be credited. Okay. So when we're doing a discount amortization, the cash that we're paying them is always the interest payment. Okay, interest is always calculated principal times the semi-annual interest rate. Okay, they already told us that, $50,000. Okay, so our cash is going to be a credit of $50,000. That's the interest that we're paying them every 6 months. Okay. So cash is $50,000, and then this is just one interest payment, right? We're going to make, we have a 5-year bond, so all total over the life of this bond, we're going to make 10 payments that look just like this. So what I need to do is I need to take my full discount amount and amortize it or spread it over the life of this bond, okay? So how much of the discount do I want to recognize here? Or how would I calculate it? Divide what? You're on the right track. We do divide by 10 because that's the number of full payments. But we actually don't want to divide this. We want to take our discount amount. Very close though. Okay. So you're going to take, what's your discount amount? How much did we discount this bond?
$100,000.
100,000, right? It was issued face value of 2.5 million. We received cash of 2.4 million. So the first step is figure out your discount amount, okay? So your discount amount is the face value minus the cash proceeds, or 100,000. Okay. That's the full discount amount. Well, we want to spread this discount over the life of the bond. Well, we're going to make 5 years worth of payments twice a year. Whoops.
You said the discount amount equals what again? I just want to type this down.
Face value minus the cash received, the proceeds, okay? So the face value minus the cash received is the discount amount. Okay, so to amortize that discount, we take 100,000 divided by the total payments. Well, it's a 5-year bond and we make 2 payments a year. So we're making 10 total payments of interest over the life of this bond. So every time we make an interest payment, we also want to recognize 1/10 of the discount. Okay, we're amortizing using straight line amortization. Okay, so how much of the discount are we recognizing? 10,000.
Is this the one that you can do it multiple different ways? Because that's not how I did that.
How'd you do it?
I took the 2.5 divided by 10 times the 4%. Is that what I did? I think that's what I did. Yeah, so I thought it was weird.
To get the discount amount?
Yeah, 250. I mean, times 4,000.
I don't think that always works.
Okay.
Yeah. Like, that doesn't sound right.
It worked for this problem.
It did. Well, that was a lucky one. Okay. So every time we make, we're paying them 50,000 cash interest. That's the interest payment that we're making to them. We want to recognize 1/10 of the discount because we're making 10 total payments. So discount on bonds payable gets credited 10,000. Very good. Our interest expense is the full 60,000. So the interest expense is the cost of issuing this bond. So it's the 1/10 of the discount plus the cash interest we're paying them. That's the total expense of this bond to us. Okay. So again, the reason we amortize these bonds is we want to know the interest expense every year. So we take that discount and spread it over the life of the bond. So we are following the matching principle, where we're recognizing expenses in the period in which they were incurred. You remember those good principles. Okay. So on a discounted, when we're amortizing a discount, you're debiting interest expense. You're crediting discount on bonds payable by taking the discount amount and dividing it by the total number of payments. And cash always gets credited for the interest payment. Okay, it doesn't matter face value, discount, premium. Cash is always principal times rate times time. Okay, and the rate is always the contract rate of interest. So we're always taking the principal times the contract rate times time. Any questions on that one? Okay. We did that one. So now I'm skipping over to what, number 8. So the last two, you can imagine, are dealing with premiums. Okay. So we're dealing with premiums. So a little different, of course. Okay. So issuing a bond at a premium. It says on the first day of the fiscal year, a company issues a $7,500,000, 8%, 5-year bond, and they give you the annual interest or semi-annual interest of $300,000. We receive cash of $7,740,000. We want to journalize the bond issuance. Again, I can tell that I'm issuing this bond at a premium because I'm receiving more cash than the face value. Okay. So what's my journal entry for the issuance of this bond?
Cash.
Good. For how much?
For the 7,740,000. Oh gosh, 7 million, my bad.
The cash is debited for the amount that we received, the $7,740,000. Okay. And then what else do I do?
Then you will credit bonds, our premium on bonds payable,
Good. I'm going to credit premium on bonds payable for how much?
or the difference between, the bonds.
Very good. Yeah, the face value and the cash proceeds, right? In this case, we receive more cash, so we would take our $7,740,000 minus the $7,500,000. So the premium, or the amount that we received in excess of face value, is $240,000. Okay, so just the difference between the face value and the cash received. Okay, in this case, it's more, it's greater, so it's a premium. And what else do I credit?
Bonds payable.
Bonds payable. Very good. For how much?
For the face.
The face value. Very good. So again, bonds payable is always credited at the face amount. Cash is always credited for the amount of cash received. So whether it's a discount or a premium, you're just subtracting to figure it out. Obviously, when we receive more cash up front, then it's a premium. The premium on bonds payable gets credited the difference. Okay. Any questions on that one? And last but not least, of course, now we want to be able to amortize a premium. So we have, again, the same bond, and we want to journalize the first interest payment and the amortization of the bond premium. Okay. So what do I debit and credit here?
Debit interest expense
Good.
and debit premium on bonds payable.
Good.
And you're gonna credit cash.
Very good. Okay. So interest expense will be debited, premium on bonds payable will be debited, and cash will be credited. Well, how much am I crediting cash?
774,000. Well, 7,700,000.
No, but you have to also times that by the percent and times it by the
300,000.
Yeah, the 300,000. They actually gave us the interest payment, but you're on the right track. If they didn't, you know how to calculate it, right? So right, cash is always credited for the interest payment we're making. So principal times contract rate times time, but they gave us that 300,000. So we're paying, not 3 million. Getting a little happy with my zeros. 300,000 gets credited to cash. That's how much interest we're paying them. Well, how much is my premium amount? We already calculated that, right? So we calculated our premium, which again would be the cash value minus the face amount
divided by the
and divided by the number of payments. So our premium is 240,000. And we divide by, this is a 5-year bond, and we make 2 payments a year. So again, we're going to make 10 total payments. So 240,000 divided by 10. So every time we make an interest payment, we want to recognize what, $24,000 of that premium? 24,000 is the amortized premium amount that I debit. Very good. The interest expense, we're going to take the cash minus the premium on bonds payable to get the interest expense. That would be like what, 276,000? Why do I subtract there? Besides that it's a debit and a credit.
because what you receive is greater.
Right, yeah, you're receiving more cash up front, right? That premium is a benefit to us. We're receiving more cash up front. So that premium is reducing our total interest expense every month or every 6 months. Good. So when it's a discount, it's a cost to us, right? So when we're amortizing a discount, that's increasing our interest expense. But a premium is reducing our interest expense. And then if it's sold at face value, they're the same. There's no benefit or loss. Okay. Remember, the whole idea of doing a discount or a premium is to make the bond more attractive and more equitable to the current market rate. Okay.
Does this change if you have international buyers?
Outside of like currency conversions and things like that, it shouldn't, unless there's certain taxes or something.
It's asking like the difference between unknown
with the 7% interest, a 7% interest bearing note or a note discounted at interest,
Okay.
not like what's the difference?
Well, your overall, there's no real difference. It differs in, remember, with a note that bears interest, you're going to receive the full face value up front in cash. And then when you pay it off, you're going to pay the principal plus the interest. Okay? With a discounted note, they're taking that interest off the top. So when you pay it back, you're going to pay back the face value, but they've taken the discount off the top. So really, like, when you compare them, if they have the same rate, you're paying the same total, whichever way you calculate it. You just get a different proceed up front.
Which would be better for the borrower?
What do you think?
I don't know, I'm thinking how this is like a 7% interest bearing note. They get the base and then pay
When it matures, yeah, they're paying the face value plus the interest. Do what?
discounted at.
On the discounted note, they're receiving less money up front and then paying the face value when it matures. No, because they've already calculated the interest up front. So they took the 7% or whatever.
Interest off.
Uh-huh.
So it's just
So with a discounted note, all the difference is that you're basically from the creditor side, they're taking that discount up front. So they give you the proceeds of the note. The proceeds of the note are the face value minus the discount amount. So you're getting less money up front, and then you're going to pay off. When you pay off the face value, though, when it matures, you're paying that interest. Does that make sense?
yes, because you receive less, the borrower receives less.
Uh-huh. So would it be better from the borrower's standpoint to receive the full face value or face value minus the discount up front?
They want the
Yeah. Mhm. And that's because if you receive the full face value, if you put that money into an interest-bearing account, you could make more interest over time on it. Versus if you took the discount, you're going to have less money to invest. Yeah. But ultimately, as far as what you're paying in interest, is the same under either method. Any other questions on 10, 11? Anything?
Fish freeze. Yeah, I get it.
Okay.
I just want to reiterate.